Hey Chris,
Cameron?
just a quick update. We're getting lots of inquiries at the moment on the proposed new Division 296 tax. So what we thought we'd do is just take everyone through the actual mechanics of how it works. It's very hard at this juncture to work through potential strategies to be able to potentially reduce the tax. We've got one worked example that we'll go through, but because we don't actually know what it looks like. But we thought we would take everyone through exactly the some of the detail.
At least conceptually.
Today.
Like anything, the devil's in the detail.
Yeah, that's right. So this was actually announced back in February 2023, which a couple of years ago now, as part of the Better Targeted Super Concessions Bill that was introduced at the time, and it lapsed in March 2025. At the moment, it's in the Senate, and subsequently there is some of the main objections around it is the cap or the threshold of $3 million is not indexed. But what it actually does, and this is the part that's in my mind really controversial, and in fact, can I say it wrong? It taxes unrealised capital gains.
Yeah, well, it's the first time it's happened, right?
Yeah.
It's unusual. It sets a precedent, which I don't necessarily like, but I guess it's just, if it's passed, it is what it is. Can't change it.
Well, that's right. But it sets a precedent around the world too. There's
correct.
no other countries around the world tax unrealised.
Yep. You pay your tax when you sell something.
So currently the Labor Party is working with the Greens to confirm what the methodology is going to be and the effective date. It looks like the effective date is going to be the 1st of July.
This year, 25. Yep.
So let's just go into perhaps a little bit more detail about it. So how it's proposed to work. What it is, it's essentially a tax. It taxes a proportion of earnings that is attributable to balances over $3 million.
Yep.
And that tax is going to be taxed at 15%.
I think it's important probably to flag here that the balance is inclusive of money in accumulation and in pension per member.
Per member.
Because I've had this conversation in the last week where clients in a self-managed super fund with 2 members nearing it, getting worried and saying, well, hang on, no, it's per member. It's not at a fund level.
Yeah, that's right. That's really important. Essentially, think of it how it's calculated. It's calculated as the difference in the total super balance.
Yep.
So if your total super balance, let's keep it simple, was $3 million as at the 1st of July, and then was $4 million at the 30th of June the next year.
Yep.
Then that's an increase, and that's the part that is going to be attract some of the tax. But importantly here, it's the proportion that actually also matters as well. So,
absolutely.
And that's the part that I'm finding a lot of my clients are getting perhaps a bit confused over. So we'll go through some of the detail on that in a minute. Some of the other things that are particular to this tax is negative earnings are recognised as well, and they're carried forward. So if you went from 4 million to 3 million, that is recognised.
Yep. There's some worry there for a while that wasn't going to be the case.
Yeah, that's right.
Yep.
So that can be carried forward and offset.
Yep.
It's a tax assessed and levied against the individual. So probably to your point, it's a member balance.
Yep.
And you can release the tax if it's payable from your super fund.
Yep.
Now this part's a little bit controversial. If you're a defined benefit member, like most MPs, that's the controversial part, you can defer it.
Yeah, interesting. I can understand why they've done that in terms of like a fund structure, but if you put it in a certain viewing frame, you can see it doesn't look great. Yeah,
not particularly politically palatable.
Yeah,
is it?
correct. Yeah.
All right, let's work through a worked example here. So in this case, we've got Jack. Jack's got an SMSF. He's got a balance of $3.5 million in it as at the 30th of June. He made contributions during the year of $30,000. He withdrew $50,000. And as at the 30th of June 2026, his balance is $3.85 million. It's important to note that contributions are subtracted.
Yep.
and withdrawals are added in the calculation of what the earnings amount is.
Yep.
And it's only the amount above the $3 million that's included in the tax calculation. So let's just work through some of the detail of that. So on the right-hand side there, you can see that the opening total super balance was 3.5, contributions, withdrawals, closing total super balance is 3.85. So therefore the earnings, notional earnings, have been 372,500. The amount that is above the $3 million is 850,000. So you've got 3.85. Now this is the part that we need to probably go through in a bit more detail. It's only the amount above 3 million that is counted in the calculation.
Correct.
So in this case, that's 22%.
Yep.
So 850 is 22% above 3.
Yep.
So subsequently, the earnings that the fund's made, so the fund made earnings for the year are $372,500.
Yep.
The earnings that are attributable to the amount above $3 million is only $82,240. Yep. And so subsequently, you pay the tax, the 15% on that amount.
Yeah, makes sense.
Yeah. So in this case, it's can I say this? Only a $12,000 tax.
Yeah.
For Jack in this case.
Yeah, I think there's been a bit of just misunderstanding, I think, and not having the information from the legislation previously, where people were thinking they're going to get taxed 30% of their balances over $3 million, or the total value of the fund. Yeah, it's been like, to your point, it's, I guess,
well, the way it was previously explained was, if you had a $3 million balance and it went to $4 million, you made $1 million, you paid tax of 15% on your $1 million.
Yep.
150 grand.
Yeah, it's a lot of money. Yep.
It's not that.
And especially for those, there will be people out there who have large, lumpy assets that maybe aren't as easy to potentially liquidate. I think the aspect here is that planning is going to be the key point, and that 30 June number is important. So I think for clients who are in this position, end of year tax planning is going to have another component to it, essentially,
that's right.
To try and manage this. As you said before, legislation hasn't been actually enshrined yet, so strategies to legally minimise that. We're waiting in the wings, but there will be some.
I had a client the other day ask me, well, should I just take out the entire balance above the 3 million?
Yep.
And so what we did is we just put a bit of a scenario together for said client, whose name isn't Brian. So in this case study for Brian, what we're trying to get to here is what would be the tax after 10 years and 20 years if we left the money in super, total tax payable. And so what you can see here is if you leave the money in super, tax payable is about $200,000. If you take the money outside super, so in this case it was $1 million, so you take the money outside super, you invested it with the same investment strategy, you're looking at tax payable of just a bit more, slightly more, it's about $205,000 after 10 years. So you actually pay more tax. This after a 10-year period. After 20 years, so again, same concept, and the distinction here though is that we're actually selling the assets in 20 years' time, and that may well be through, because that's what should happen, or pass through to the next generation. But if you leave the money in super, the amount of tax that was paid is about $740,000. Versus if you invest the money outside super, you get all the returns, you pay the tax along the way, the income tax along the way at the higher marginal rate, plus then you do, you cash out, you pay your capital gains tax outside of super, you end up paying tax of about $820,000. Interesting to me how close these numbers are. And really, I think what the government's trying to do is just, obviously raise revenue, but make it less advantageous to have very high superannuation balances.
I think that was one of the things that I took away as part of that conversation I was having with clients earlier this week, is the rule changes that the government brought back in a few years ago around having $1.9 million in pension. So basically the government said, look, you can have a certain amount of money tax-free in pension mode, but we're going to limit that. Essentially what I feel this is they're saying, well, we're going to limit the amount of concessionally taxed money that you can have in superannuation.
Yeah.
So we'll give you a pool of money that we think is reasonable, and anything over and above that needs to be more, I guess, aligned to the rest of the tax system, I suppose. But I think it just adds some complexity, and I'm not sure the execution is particularly...
Can be done better.
I think so, yeah. But I guess, as I keep saying, it is what it is once it's enshrined. But it's just going to be planning.
One of the things that I should have mentioned it earlier, but I didn't. One of the things that keeps coming up, and I even noticed it in the Fin, they keep talking about it as a tax at 30%. It's not a tax at 30%. No. It's a tax at 15%, as we explained it.
Yep.
Having said that, you still get the amount of money you got in accumulation phase. You still have to pay tax on that.
Yep.
On the earnings.
Yep.
So, realised capital gains.
Yep. Income,
dividends, you still have to pay tax on that, which is the tax rate in accumulation phase is 15%.
Yep.
Or 10% on realised capital gains.
Mm-hmm.
So this tax is on top of that, but it is not a 30% tax.
Yeah, correct.
All right, thanks, Chris. I appreciate your guidance on that. That's really great. So, look, if anyone's got any questions about it, or want to try and understand what it means, for them, we of course will be in touch about it. But feel free to reach out, and we'll run the numbers.
Yeah, there's a lot of little moving parts in here, so it's important.
Thanks, everyone.
Thank you.
See you soon.